Hey everyone, this is Matt Grossman from Barchart. And today I'm lucky enough to be joined by Ed Eglinski from Direxion ETFs. How you doing, Ed?
How are you today? Good to be here.
Good. I'm glad that you're here. Why don't we start out with this? Will you tell us a little bit about yourself and Direxion?
Sure. As you can tell by the hair, I've been in the financial industry over 30 years. I don't want to date myself. I've been with Direxion for 13 years. I head up our alternative investments and global sales for the organization. Direxion has been in existence for 25 plus years, is a top 20 US based ETF provider in terms of AUM. We're about 45 billion in assets, and primarily our firm has leverage and inverse ETFs. So we're primarily an ETF provider, but unlike most ETF shops, we have tactical trading tools, whether they're bull or bear, with different leverage points ranging from an inverse 1x bear to 3x bull and bear on the daily returns of broad indices. And as we'll talk about also, individual stocks in some cases.
And one of the things that I know about Direxion is that a lot of your ETFs are targeted for active investors.
That's correct. These are designed for short-term active trading. The word daily is even in the name of these leverage and inverse ETFs. We'll get into that, what that represents in a minute. But they should be monitored on a daily basis. So if somebody is not going to be focused on trading from a day-to-day standpoint, these are probably not the appropriate vehicles for them. These are not buy and hold vehicles or set and forget vehicles. These are for short-term active trading.
Great. Thanks for that information, Ed. All right. Our next topic that I want to talk about is semiconductors. Now, semiconductor stocks were some of the most impressive performing stocks of all stocks in 2024. You could not look at any financial website, including Barchart, and not see articles about, including now, NVIDIA, Taiwan Semi, so on and so forth. So this is a very exciting industry that's getting a lot of attention and has a lot of volatility to it. What do you think's going on with the semiconductors industry in 2025?
Yeah, certainly a lot to chew on there. You have a lot of uncertainty. There's a lot of geopolitical risk. The tariffs, as you mentioned before. I think you can't help but look at China and U.S.-China relations and what the impact might be on U.S. chip makers. The administration is talking about increasing curbs on U.S. chip makers in terms of their supplying to China companies. They're also looking to restrict China investment in U.S. tech as well. And so when you're looking at China right now, the U.S. chip makers are looking to really, the government's looking for the U.S. chip makers to build more within the U.S., very concerned about the security risk with China. And right now you're seeing that even with Taiwan. What the impact or the influence of China on Taiwan. And Taiwan's currently, the majority of the advanced computer chip production is based there. So, one of the single stock, leverage and inverse single stock that we have, 2X bull and a non-leverage inverse bear on the Taiwan Semiconductor on TSM. And what's the impact going to be there on that stock? They're the largest contract chip maker. They have committed to building plants in the U.S. We have a couple of ways you could trade that individual semi. TSMX is the 2X bull and TSMZ is the inverse 1X bear. You also have to look at the possible revisions to the CHIP Act. There's even more of an emphasis, I think, on U.S. production. Just recently, Apple, no coincidence, when Tim Cook met with Trump, Apple committed to invest $500 billion in the U.S. over the next 5 years. What's the impact of some of all this? It could raise costs and impact innovation, depending on how much restrictions we have with some of our global partners. There's an opportunity to trade the semis from a broader standpoint. Our most popular fund, and I think it's a combination of the high beta associated with it, and now the AI aspect to it, is our triple leverage bull and bear on the ICE Semiconductor Index, which is a basket of semiconductor stocks. SOXL is our biggest fund in terms of AUM, is triple leverage bull. We also have the bear SOXS as well. And if you wanted to play the semis, what I'll call a la carte of some of the individual stocks, we have a 2x bull and non-leverage inverse bear on NVIDIA, Broadcom, Micron, Taiwan Semi, which I mentioned before, and AMD as well. So not only do we have the index that you could trade, bull and bear, on the triple leverage of the semi space, but also the individual, some of the biggest names in the semiconductor space on an individual basis, rather, on a 2x bull and an inverse 1x bear base.
Yeah, I think these are great tools because there's no way that we're not going to continue to see a lot of volatility in the semis in 2025. Ever since DeepSeek came out and surprised everyone, I was going to say the market, but it really just was everyone across the board. You've just seen increased volatility in these names. I mean, the day after, there was a big sell-off, and then there was a big rally. And today I saw DeepSeek making some other headlines as well. So I think this is going to continue. This is the technology that everyone across the world really has in focus right now. And I see a ton of movement. I mean, while we're recording this, I think it was yesterday, Palantir saw a 10% down move in its stock, 10% in a day. Again, I'll refer back to my previous professional life when I was a trader. We used to just wish for days like that, because when you get strong movement is when you can really capitalize on opportunity. So having those tools that Direxion has, they amplify that movement. And I just think for any active trader, there are tools in their quiver that they really should pay attention to for these semis, especially over the course of 2025.
Yeah, without a doubt. I mean, let's take it from a broader perspective. The DeepSeek news certainly raises some questions and concerns about the amount of CapEx spending, but by tech in general, particularly a lot of the semiconductor names, and also China building something that's comparable to possibly OpenAI at a fraction of the cost, if you believe them, and take that at face value. So you mentioned the AI stocks. They did definitely rally considerably in 2024, such as Palantir you mentioned. We have a single stock, PLTU, PLTD, if you want to trade 2x bull or non-leverage inverse bear of that stock. Palantir is still up for the year, although over the last week and a half, it has pulled back considerably, partly due to the DeepSeek news, but also due to Doge. They have a lot of government contracts, and that might be adversely impacted by some of the potential cuts by government spending. So when you look at valuations right now, overall in a lot of these stocks, particularly Palantir, it's high. And the question is, can they continue to monetize the AI to justify the current multiples? So we see a lot of individuals, particularly that own the Mag 7, and there's been some tremendous gains there, albeit this year, 6 out of the 7 Mag 7 are down year to date in 2025. So it hasn't been a Mag 7 story thus far this year, but a lot of people that have owned the Mag 7 in a buy and hold capacity, non-leveraged I'm talking about, have embedded gains maybe. They don't want to sell due to taxes in some cases. So a non-leveraged inverse bear we have on all the Mag 7. Potentially you could hedge and protect some of those gains by using a non-leveraged inverse bear. Also, if you feel some of these stocks are overvalued, you can take an outright short position through a packaged ETF. Most of your clientele, your retail clientele, very difficult to short individual stocks. There's unlimited liability and there's significant costs. Here's a way to do so in a packaged ETF. So you still have to be monitoring this daily. If you want to hedge your long exposure, you want to at least be cognizant of what that hedge is because it's going to move. So you want to have those percentages at least. You want to at least rebalance as often as you want to just make sure you have that hedge in place of whatever percentage that is.
Yeah, one of the things that I think these inverse ETFs are especially useful for, who they're useful for, are people that are trading in the retirement accounts. So you're not allowed to short stocks in certain retirement accounts, the ones that most people know. But let's say, I'll let you take it over here, but let's say an active investor believes that Palantir is going to go lower. Well, they can take advantage using the I'm not going to do PLTU?
PLTD.
PLTD.
So it's down as up and down. So PLTU, 2x bull, PLTD,
Up, down,
inverse 1x down. So give marketing credit for that. That was pretty good with the symbols there. It's interesting with ERISA accounts. Yes, that is the case, but you really should have your audience check to see what's allowed or what's not within, depending on their tax exempt type of account. But individuals are using non-leveraged inverse ETFs as a way either to hedge their gains or their long exposure, or an outright short, but in a package ETF like I mentioned. But they still need to be monitored daily. Keep in mind, though, it's a non-leveraged 1x daily. What does that mean? So let's say Palantir is down 3% today. That inverse 1x product would be up 3% minus fund fees and expenses. But after one day, there is going to be something called compounding, because that daily that we mentioned in terms of part of the name of all our leverage and inverse ETFs, why is it in there? Well, daily is when the leverage is reset on a daily basis at day's end. So what happens is the next day, there's going to be compounding. So these are very path-dependent type of trading vehicles. The trend is your friend. So whether you're in a bull or bear fund, the higher the leverage point, the more impact it's going to have in terms of whether the leverage helps or significantly hurts you, especially a 2 and 3x product, whether it's bull or bear. So when you're trading these vehicles, every day is a new day. And what you're looking at basically is if something's stair-stepping in your direction, the leverage can work in favor of you. But if it is choppy markets or it's going against you, that leverage could magnify your losses. And just as an example, we have triple leverage, let's say, or double leverage products, bull and bear of the same index, the same pair, that over a given longer period of time, in a given year, depending how volatile the underlying index is, both could be down over a longer period of time. So why am I mentioning that? Is because the fact that you have to look at these as short-term trading vehicles and look at the trend of that underlying index. And there's going to be compounding over time, and there could be some negative impacts to that compounding if you're on the wrong side of the trade, or a lot of markets sometimes are directionless and they're very volatile up and down for a period of time. Both a bull and bear product can lose money over that period in that scenario.
No, I'm glad we talked about that. I think it's really important for any active investor to know. Well, good. Well, thank you for getting a deeper dive in there. Well, Ed, thank you so much for your time. It's been a really insightful conversation, and we really appreciate it and hope that we can talk again soon.
Sounds good. Take care.